I once saw a man try to build a beautiful 3-story house on a patch of wet sand because the view was better there. It looked magnificent for a month. Then the first storm rolled in and the house didn't just crack, it vanished. Most people treat investing the same way. They chase the view of high returns before they've poured the concrete of a foundation. Today I want to tell you why your emergency fund isn't just a savings account. It is the only thing that actually makes you a successful investor. Back in the late 80s, I thought I was a genius. The market was moving, I had a little money in a few hot stocks, and I felt like I was finally ahead of the curve. I didn't have much of a cash cushion, maybe a couple $100, because I thought, why let cash sit in a bank earning 2% when the market is giving me 10%? Then life happened. It wasn't a market crash that got me. It was a transmission. My car died on a Tuesday. That same Friday, the refrigerator gave up. Suddenly I needed $3,000 I didn't have. I had to sell my investments. But because I was in a rush, I sold them when the market was down that week. I took a loss, paid a commission, and felt the sting of realizing I hadn't been investing at all. I had been gambling with my survival money. That's when I understood. An emergency fund isn't lost investment capital. It's the armor that protects your investments so they have the time they need to grow. On paper, the math seems simple. Invest every penny because historical returns beat bank interest. That looks optimal on a spreadsheet. But spreadsheets don't have children who get sick. They don't have roofs that leak or companies that downsize. The real problem is fragility. If your financial plan requires everything to go perfectly for it to work, you don't have a plan, you have a hope. Investing is a long-term game, 10, 20, even 30 years. The only way to win a long-term game is to make sure you aren't forced to quit in the short term. Your emergency fund is the stay-in-the-game fund. Without it, you become a forced seller, and forced sellers almost always lose money. Lesson 1. The psychology of sleep equity. There is a return on investment you'll never see on a ticker tape. I call it sleep equity. The rule: an emergency fund is for peace of mind, not for wealth building. Imagine the market drops 20% tomorrow. If you have no cash, you're terrified. You might panic sell at the bottom. But if you have 6 months of expenses in a boring savings account, you look at that drop and you don't blink. Your groceries are covered. Your rent is covered. You can think clearly. Stop judging your emergency fund by its interest rate. It's not a lazy asset. It's a defensive asset. Its job is to sit quietly so your investments can work without interruption. Lesson 2. The sequence of returns trap. Some people say, why not just use a credit card for emergencies and invest the cash? That's dangerous. The rule: emergencies and market downturns often happen at the same time. In a recession, markets fall, and that's often when layoffs happen. If you lose your job and the market is down 30%, you're forced to sell investments at a steep discount just to buy groceries. You lock in losses that might have taken years to recover. Before increasing your investment contributions, make sure you have at least 3 months of bare-bones survival expenses: rent, utilities, basic food, nothing else. Lesson 3. The opportunity fund mentality. Here's something most finance gurus won't say. Eventually, your emergency fund becomes an opportunity fund. The rule: cash is king when everyone else is desperate. When the economy hits a rough patch, prices drop: stocks, houses, businesses, equipment. If you have a fully funded emergency account plus a little extra, you're not just surviving the storm, you're positioned to act. Once you hit your 6-month goal, don't stop saving entirely. Keep a modest opportunity reserve. It gives you the power to say yes when real value appears. Lesson 4. The order of operations. So what comes first? It's not either or, it's when. The rule: secure the floor before you build the ceiling. A practical order might look like this. Starter emergency fund, $2,000. Employer match. If your company offers matching contributions, take the free money. High interest debt payoff. Full emergency fund, 3 to 6 months. Serious investing. If you're investing while carrying high-interest credit card debt or sitting on zero savings, consider pausing. Redirect that money into your foundation for 90 days. You may feel the stress lift almost immediately. Lesson 5. The liquidity misconception. People think liquidity means I can sell it quickly. True liquidity means I can access the full value quickly. Stocks can be sold in seconds. But if they're down 40%, you haven't accessed your money. You've destroyed part of it. Keep your emergency fund in a high-yield savings account. Separate from checking so you're not tempted to spend it, but accessible within a day if the water heater explodes. Practical plan checklist. Here's how to build your foundation. Calculate your must-haves. Rent, food, utilities, insurance, nothing else. Build your first $2,000 quickly. Sell items. Work extra hours. Create momentum. Keep it in a separate account. Out of sight helps keep it untouched. Invest only enough to get your employer match while building your fund. Aim for 3 months if your job is stable, 6 months if you're self-employed or supporting children. Define emergency now. A vacation is not an emergency. A new phone is not an emergency. If you use the fund, rebuilding it becomes your top priority. Review it yearly to adjust for inflation and lifestyle changes. Some say, "But I'm losing money to inflation by holding cash." Maybe you are losing 3 or 4% in purchasing power. But that's a small insurance premium to avoid being forced to sell investments at a 30% loss. Don't step over dollars to pick up pennies. Others say, "I have a high-limit credit card." A credit card is not a fund, it's a loan. In a true crisis, banks can lower limits without warning. Don't bet your family's security on a bank's permission to borrow. And some say, "I'd rather take the risk and grow faster." Risk feels good when markets are rising, but when the tide goes out, you find out who was swimming without protection. I've seen many fast investors end up broke. I've seen very few steady ones fail. This video is for education only. I'm not promoting any platform or guaranteeing results. I'm not a financial advisor, just a neighbor who has seen a few winters. Consider speaking with a qualified professional about your specific situation. Building a foundation isn't glamorous. No one applauds when you hit $10,000 in savings like they do when a stock doubles. But the first time life throws a punch and you simply shrug because you have the cash, that's the best return you'll ever experience. So let me ask you, on a scale of 1 to 10, how solid is your foundation right now? If a $3,000 bill arrived today, would you feel calm or would you scramble? Let's talk about it in the comments. If you're looking for a slower, steadier way to think about your future, I'd be honored if you subscribed. We're building something solid here. Be well.